Today, we're going to demystify private equity and venture capital funding. So today's guest is a partner at Equiam, a venture capital and growth equity firm. He's also a family, so you are going to learn what only insiders know. Welcome, Arin.
Thank you, Artin and Michael, for having me.
Yeah, no, it's a pleasure to talk to you outside of family functions. Tell us a little more about kind of your background expertise in venture capital and private equity, and how'd you even get into it?
Yeah, it's a great question. So I've been in the investment industry for about 15 years now. I always knew I wanted to go into finance from a young age. So after college, I headed over to Wall Street to work for Lehman Brothers in mergers and acquisitions. And I always thought I was going to go into public market investing, so hedge funds. But as it turned out, just from my experience and where I worked and what I did, private equity became like a more attainable field. And the more I learned about it, the more I liked it. So after working through my analyst program at Lehman, I jumped right into private equity. So I started at the bottom of the totem pole, which is how everyone starts in the industry, as an associate at a firm called Griffin Investors, investing in private equity and kind of what it's called middle market or lower middle market. I'll explain that a little bit later. And then from there, my career progressed. So worked at Griffin for a few years, went and started kind of the investing program at another private equity firm, Kingfish Group, worked there for about 5 years. Took a little bit of a break, traveled around, and I was connected to one of the original 150 partners pre-IPO of Goldman Sachs. So Goldman Sachs used to be a partnership that went public. Those original partners made, good amount of money, and most of them set off on their own to manage their own family office capital. So I worked with his individual name was Mike Ryan. I worked with him for a few years. And that's when I got into more venture capital investing, earlier stuff, later like stage venture capital, growth equity. And from there, I connected with the Equiam guys here, which is Ziad Makawi and John Zick. They had founded the firm back in 2019. During COVID, I was looking for something to do. I found out what they were doing, and I'll kind of explain how we're a little bit of different venture capital firm in a bit, I'm sure. Joined up with them and was kind of a partner here for the last few years.
That's awesome. So I think a lot of people probably don't know this, but can you kind of explain what's the difference between private equity and venture capital?
Yeah. So there's a lot of different intersections of differences between the two, a lot of layers. So, we can go into the capital structure. So, when you're doing a venture capital deal, you'll say, I'll put in $10 million for 10% of your business, right? And this $10 million I'm giving you as an entrepreneur, hopefully is for you to go grow your customer base, hire a bunch of smart engineers and salespeople and make a good return. That's venture capital. And venture capital can, span from early stage where it's a guy with an idea and you give him $500,000 to develop that idea, all the way to, SpaceX and Instacart and all those companies who were $10 billion companies who needed to raise money to continue funding operations and growing their markets. So it spans a whole spectrum. On the other hand, private equity, the capital is usually 9 times out of 10, you're going to buy the whole company. So you're going to go to an entrepreneur and say, hey, you built a great business. You're in your 50s or 60s. You want to go play golf every day. How about you sell me this business and I will pay you X amount of money. And unlike venture capital, where you give someone like, $1 million or $10 million for a percentage of their business, in the private equity, you're buying the company and you're usually financing it with debt. Okay. So you're saying, I will give you $100 million, owner. I will take $50 million of debt from a bank and I will put $50 million of my own money in. So it's kind of like a split, somewhere between usually 30 to 60% debt. So that's one other difference. It's also kind of the types of companies you're buying, the maturity level. So private equity companies, I like to tell people, the wealthiest people in this country isn't the guy you're seeing driving the Lamborghini in Beverly Hills. It's actually the guy in Conshohocken or, somewhere in Wisconsin who owns a plastics company and it's worth hundreds of millions of dollars. Over 60 years or 50 years, he's built this business up and he's ready to sell it to you. And, that's the company. Whereas a VC here, this is very stereotypical, but it's true. You might be, financing the kid out of college for a couple of years who's got an idea on tech. So it's kind of a different type of capital structure, different type of risk, different type of person you're dealing with.
And then what would you say is the goal of it? Like when you do private equity, what would be the goal? Is it to sell it again? Is it to spin it off? Like why would you do that?
There's a few goals. One is you're usually underwriting to a specific timeline, like 3 to 5 years. Okay. Now, it doesn't always work that way. Sometimes you sell in a couple of years and sometimes it takes 10 years. But you say, I'm putting 50% of my own money, 50% debt. I, as a private equity investor, have operational expertise, or I can bring in people with operational expertise who can take this business and take it to the next level. So that's one way. And over those 3 to 5 years, you're going to, I'll give you an example. You buy $100 million business, right? You put $50 million of your own money, $50 million of debt, right? And you bought this business at $100 million with $10 million of profit. So 10 times 10. Let's say in about 5 years, you've grown that $10 million of profit through your operational expertise, cost cutting, growing market, whatever kind of different type of private equity firm you work at will have different kind of ways of doing this. You grow that $10 million to $15 million. Okay. So now you sell it for 10x, you've sold it for $150 million. You haven't made 1.5x though, because you paid off that $50 million of debt. You put in $50 million, you sold it for $150 million. You made 3 times your money at the end of the day. So that's the goal of private equity. It's essentially using other people's money.
I'm trying to do that for smaller businesses now that are, we're talking more like 1 million SDE or somewhere around there I'm looking at versus that size. But the challenge is that private equity is even scooping up, businesses of that size now. So it's actually making it a little bit harder to try to find those businesses as well. You almost have to go under that, where they're like, we'll wait until it hits that magical number for us. But I know over 3 million is also what a lot of private equity likes.
3 to 5 million is kind of the minimum of the firms I've worked at, and it's been on the small side. So this is a common misconception, but people think of private equity firms and they see the big $10 billion private equity firms going out and buying, Toys R Us and, PetSmart, those types of companies. 98% of all private equity deals are this profile. It's a company with about $1 million to $10 million or $20 million of revenue, family owned or founder or third generation who doesn't want to run it anymore, small business, but very profitable, has a niche in the market. And those are the businesses that private equity loves every single day.
I think it's actually one of the best investments somebody can make today as far as returns go, especially because, as you said, when you start getting a business to the point of where the way those multiples work, as well as how well those multiples work for you, if it is, has leadership in place so that when private equity comes in, they can still let it continue to do that, but maybe start adding some of their magic sauce if they want to continue to benefit from it. But it's incredible. Beats real estate or anything else.
It does. There's a lot of when you buy a company that's, 40 years old and has been run by one entrepreneur, they know how to do things one way and that's their way. But if you can bring in a fresh perspective, fresh talent, and really grow the business, I'll give an example that's probably very near and dear to Artin. So, in my previous roles, we were looking at buying a set of marinas, boat marinas. And, this has been run by a family business. They had a bunch of marinas. It's a $100 million company. We wanted to bring in an operator who can help spruce up the marinas, make them better looking, more high end. We reached out to the former Disney's parks and resorts. So this is a guy who ran a $10 billion portion of Disney, okay? Retired, but was looking to keep himself busy, being private equity, make a little more money. He was never going to be CEO of Disney. Chapek and Iger weren't going to let that happen. So he's like, let me go be a CEO of something else or on a board of something else. we reached out to him, and I was totally expecting him to tell me like, "Buzz off, little kid. Why am I going to come run $100 million business?" But he fell in love with it. So he came in and he set on this company, brought his Disney expertise on running parks and how to like make things inviting, how to make it family friendly, how to like grow the marina business. He understood everything, and it went from a $100 million business to a $500 million business in 2 years because of just one guy.
I love that park side of things, and I've always been fascinated and followed. I was curious, but that's really amazing. Who would have thought? But yet he got to continue to do the things that he loved doing when it comes to those experiences and creating these, moments for families and stuff. So that's awesome.
Yeah. And he got a chance to do it his way instead of Iger telling him do it this way.
Exactly.
Are there businesses in the private equity side of it that, or rather, are there businesses that private equity says we want to stay away from, or is it really all a matter of the financials, no matter what each time in the history?
So different private equity firms have different kind of things they won't touch. So sin businesses or some, because private equity firms raise money from outside members. So the Teachers Fund of California doesn't want private equity firms investing in tobacco companies, right? Like, or firearms or things like that. So there are certain businesses.
So more about values and okay.
But the other private equity firms, I think 3 of the 5 largest gun manufacturers in the United States are actually owned by private equity. So some, we'll go after. Others have different kind of parameters.
Yeah, no, it's fascinating. So I know you touched on it, but can you kind of go a little more deeper around the decision-making process and kind of what's involved in deciding, okay, yes, this company fits the profile of my company, of our criteria. And then what else do you look for to pull the trigger, both in private equity and now in VC, especially in early stage startups? Like what will be a good indicator?
So I'll start with private equity. It's, a kind of a defined process in a lot of ways, but also leaves room for a lot of creativity. So every private equity firm is going to have its criteria. There's a lot of overlap between most private equity firms have very similar criteria. Like we want stable companies that are growing at such rate, have good margins, are in industries that we might know. So private equity is one of those industries where if you've had success in one area, you're going to try to replicate it over and over again because you know that market. So, it's that. But once you find a company, you dive in deep into diligence. And this takes, this isn't something that happens in days. This takes weeks to months. I've had some that have gone 4 or 5 months where you're talking to the management team very closely. You're interviewing everyone from the CEO down to see, what the opportunities are, what the weaknesses are, who you might want to keep, who you might want to replace, who you might want to augment with other people. You're, doing all kinds of insurance diligence. You're doing environmental diligence. You're doing financial. You're having accounting firms come in and look at the company to see if their numbers are real. I can tell you there's a number of times where we've had, Ernst & Young come and look at the books of a company and say, hey guys, like it's not fraud. I'm not saying that there has been fraud, but this company is overstating things. So you may want to renegotiate the purchase price. And that happens often, so you're doing that. You're doing you're bringing consulting firms. If you don't know the industry, if you're not a super expert in this industry, you might bring a consulting firm to give you kind of a landscape, understand where the growth levers might be. So you're doing all of this. And all through the process, you as an investment, I don't ever make a decision alone. It's the partnerships makes a decision, right? So everyone at the private equity firm, there'll be one deal shepherd, but all the partners, kind of review things and have to vote at every different stage to keep moving forward or not until the final signing. Everyone in the firm has to say yes, this is a deal we're moving forward with or not. So it's kind of the private equity process, which is a little longer. Venture capital is a little different. And by a little different, I mean the process tends to be different with every venture capital firm. You have, and this was very true in the bubble of the last few years where, people were writing $50 million checks, having met the founder once, or having read a business plan. I'll give you an example, FTX, right? It's a big giant blow up. People wrote $500 million into that company, having one Zoom call with Sam Bankman-Fried, which, if I was an investor in those funds, I'd be very unhappy at the level of diligence they did, but it happened. And then other firms, will spend a lot more time getting to know the founders. It's a little less, private equity is a lot more diving into different points of data in a company, and venture capital is more thinking about the entrepreneur and who you're backing and the market opportunity and the market size and the potential of that. I will now make a little plug on how Equiam is different. So we are changing venture capital. So we are actually a systematic and data-driven venture capital firm. So most of the VCs is developing a relationship with the founder, looking at some data and saying, yes, we'll make an investment. We've kind of reversed the process. So we built a model, which my partners and I are responsible for building over the last 5 years, which takes in about, a couple 100 million data points on 2,000 plus active, Series B plus companies. So these are companies that are like $200 million plus companies, that are active in the United States. And we run our algorithms that we built and do data-driven analysis to rank every company from 1 to 2,000 and then go invest in the top, 1%, 2% of those companies. So we flip kind of venture capital around a little. So that's where my private equity background comes in, is I'm a little more quantitative and data-driven.
You're getting that data without necessarily seeing data within the company. It's just what's available to the company, or is that actually also diving into their own books or things like that?
Great question. That is fantastic. So initially it's without the company. So we've developed proprietary kind of scrapes and all these different things to collect information on companies. We have I think we have 18 different data providers we work for that get us information on companies, and we build, kind of algorithms to go through this data and find us insights. And then we also get information from within companies that helps either corroborate or enhance this data. And then we kind of make a decision based on that.
It makes so much sense. It is. It's like if the two, private equity and venture capital, had a baby, because it sounds, it's very much, in this case, there's more risk when somebody's investing early on in venture, but it sounds like you're saying they need to at least show a certain amount of legs to them, if you will. And then you're like, now let's jump in, because now you can analyze enough data to see what their trajectory looks like. And then afterwards, do you still, when you go in to make final decisions on recommendations, do you try to get more of a look at the books and things like that?
Yes, absolutely. So we will not make an investment unless we have that corroborate. So yes, so we're a little bit like, we don't call ourselves venture capital. We're more growth equity. That being said, I've worked in early stage, so I understand the space as well. And I can very much talk to that, and how, earlier stage, it's more about the team you're backing. In my previous role, it was kind of, the person I was managing money for had a really good saying: when you're investing in early stage, it's team, TAM, and culture. So team, TAM is the total addressable market. So how big can this company get? And the culture of the company. That's what you're really backing.
What you said earlier made me think of Moneyball. It sounds like you're the Moneyball version of venture capital, using data to take it to the next level.
Yeah. So the way we look at how we do is we are the Moneyball of venture capital, in the sense that you're never going to see us invest in a company that has 100x return. We're cutting off one end of the tail, but we're also cutting off the other end of the tail, where the guy, new NBA player who flames out after 1 year, right? We're not investing in that either. So we're looking to invest in a kind of a narrower range, where we're going to try to invest in companies that might have 2, 3, 4x type returns. And every once in a while, we get a 5 or 6x return, which is gravy, and it's fun.
That's awesome. Talk about the early stage. You talked about team, TAM, and culture. But as far as the problem that they're trying to solve, like, how much do you dig into that? And is that part of the evaluation of the TAM to see if there's something actually there?
That's 100%. That's like, if this company is not solving a problem that's real, it might be successful, but it's not worth the risk. And it's never going to be something that is going to change the world. Now, that's not to say that a lot of companies don't go out there and in the last 5 years, we saw companies who I don't think were really solving a problem that, they did well. It's just, I think if you're an early stage investor, you really have to ask yourself and the entrepreneur, what are you solving? What's your answer? What's your solution to that? And why are you the person to do it? That's what you have to ask the entrepreneur.
And how do you go about kind of looking at the problem? Like the entrepreneur could come across in a pitch deck and it sounds amazing, but how do you go about validating that problem? Like, is it even a big enough problem that somebody needs to solve? What's the process there for you guys?
So step one is determining, is this product this guy building actually solving something that's real? So the way you might go about that is, I tell people venture capital is a whole lot of desk research. You're doing a lot of research on the internet, see, what people are talking about. Is this truly a problem? You're talking to other investors who might have good insight on this. You're talking to other leadership management teams to see hey, is this really a problem in the market? And then you're seeing, is there other solutions in this market? And what do the customers of those companies say about their solution? So, I'll go online and be like, hey, this company is trying to solve I'll give you an example, in the restaurant industry, right? How you keep track of employee timesheets, right? That seems like a really simple thing to solve. Up until about 4 years ago, there really wasn't a solution for that, right? People were doing this on paper or using an out-of-the-box solution that was really complicated and not fit for the restaurant industry. But one entrepreneur who comes along and is from the restaurant industry, so understands that industry really well, says, hey, I've developed a system for this. And, you talk to people and go then in your mind, you do kind of the math, how many restaurants are in the United States, right? There's about, I believe off the top of my head, I think it's 1.3 million restaurants in the United States, right? How many people are working in those restaurants? You do some demographics on the number of restaurant workers. How much is this restaurant willing to pay per worker per month to have the solution? So you can see where I'm going. You start to build a TAM and you realize, hey, this could be a, $500 million a year, $1 billion a year type opportunity. And then you start talking okay, this is real. And then you start talking to the management team and see, does this guy have the mental acumen, the chops to actually pull this off? And then you look at the product he's built and how good is the product, how good is the engineering team? And then slowly from there, you kind of build out this model of what this company might be worth, both mentally and on paper. And, the advice I give to people is a lot of pitch decks I see. This guy will come by and say, there's 1 billion people in China. And if I could just sell this product to 1% of the 1 billion people in China, we're rich. I go, that's the dumbest thing you can tell me. You've told me nothing. I'd rather have you come and tell me there's, 5 million people and I could just sell to those 50% of those 5 million people because my product solves a solution for those people's problems. And I think that's a much more powerful statement to make.
What about the culture piece? How do you guys go about analyzing culture? Because that could be difficult.
Yeah. So, you look at, what the background of the people it is, where they come from. You talk to them, you do, interviews with them, have they overcome problems in the past? What's their pedigree? And by that, I don't mean did this guy graduate from Harvard or Stanford? I don't care. It's what has this person done in their past? They worked at Google and they were the top kind of engineer at Google, right? That tells me this person is a very smart individual who's worked in a big company and done well. Then I have to ask them, okay, you've worked at a big company with the resources of a Google. Now you're coming to work at a small company where it's going to be you and 10 other people. How are you going to manage that? And the way they kind of answer those questions tells you a lot about those people. How entrepreneurial are they? In college, did they pay their way through college by selling T-shirts at football games? That person's a hustler. I like that person. I want that person. I don't want the person who's, got a great idea, but has never really done anything to prove it.
The size you mentioned, no, because you were looking for, was it over 200 million?
So,
Or did I
Equiam, we do
misunderstand the
companies
number?
that are usually 200 million plus.
Okay. So I would assume too in that scenario, when you talk culture, because remind me, was culture one of the three things you do look at some of those? That's the after you've already done the initial, data-based analysis that you get into.
Before we have I can't go into the exact details about this because some secret sauce, but yes, we were able to kind of look at the culture of a company, and we've done analysis, and the way the employees talk about a company has a big impact on how successful the company is going to be in the future.
Okay. That's why I was curious, because I assume through that, some of that can be on, sites like Glassdoor or some of the many others that are like that out there where you have information. But then I was like, I don't know that you could look at churn easily on the outside, but that would be another way to look at it. So, okay. Anyway, that's
That's very good.
You're on the right track.
okay. There's a show I'm watching right now. I forget if it's on Netflix or where it's at. It's called Super Pumped. Have you guys seen that one?
Oh, is that the Uber story, right?
Yes, it is the Uber story. Yes, I'm familiar.
So when you
with that.
describe, some of those, and then the WeWork one I watched a while back too. Those are just kind of fascinating. Is there two of these examples of, well, Uber's a good example of the culture that has gone maybe a little too south. But then you could also see how some of these individuals early on, when you talk VC, what they're selling and what they have and the excitement around that, you could see why people will jump aboard and get excited. But it is still so interesting how ego can crush us as well.
Yeah, so that's actually two very good examples, because if you look at Uber and WeWork, the early investors in Uber and WeWork actually did well for themselves, even if they're considered failed companies in a certain way today. WeWork obviously a lot more than Uber. The early investors did well. It's actually the later investors who should have taken a much more critical eye at the kind of the financial model of the company and the operating model and how they're making money. They are the ones who didn't do well at the end.
Yeah. No, that makes sense. Yeah. So let's say that, you just greenlit and are going for it, write a $200 million check, or even in your previous experiences, how involved do you personally get in the company versus are you bringing in outside expertise and you're more kind of a little more at the 50,000 foot level?
So I would say both. So I'll start with current, and then I'll go backwards. So currently at Equiam, we don't take board seats. We don't do any of that kind of stuff. If an executive wants to talk to us and get advice, I'm always happy to hop on the phone and give advice. But we don't proactively go out there and say we're going to take a board seat. A, because we're smaller check size compared to the other investors they have, and B, it's not what our model is built on. I am not going to go to the CEO of a $700 million, $1 billion company and, tell them how to run their business. That's not our model. In my previous roles, I have gotten very involved where I've sat on boards, I've helped companies, given advice, been consultants, and done both so as myself. And also, like I said, bringing in other people, like the Disney parks person, right? Like bringing in the person who's smarter than me, who can go into the room, talk to the executive, talk to the entrepreneur, be like, hey, I've tackled this problem before. Like on a level to level, like I know what you're going through. I can help you out. And I've done that as well. Like a lot of times when you're investing in an early stage, half of it is giving the company money and half of it is being a therapist to the entrepreneur, right? Like, there's going to be hard days where they're going to call you and be like, I can't get this sale through or like this. And you just have to kind of be there, a sounding board, listen to them and be like, this is how you might want to attempt this problem. Have you thought about doing this? And kind of just being like a bit of a therapist and a sounding board.
Which sounds like sometimes leadership in general. We all end up running into that. For you though, like when you describe some of that, I'm curious, how much has like your past influenced you when you think about your own future? Do you think at all that you'd want to be more involved on, like personally investing more in business, or do you like this kind of seat you sit in where it's at? Like, how do you think about how any of this influences your future?
A great question. Honestly, I've been so busy, I haven't given that much thought to it, but I like where I'm sitting now, you know, doing what I do, because I genuinely love coming to work every day. I come into an office. That's how much I love what I don't even work from home.
You may have just solved or answered the true remote work thing. It's the idea is maybe it's not that people love working from home so much, is that they just don't like working in the office. So yeah,
That's part of it. So I love that, but I also, love helping entrepreneurs as well. And, if there's an opportunity for me to invest in a company at an early stage and be that sounding board, it's got to be a company where I believe in the mission, and B, like, I actually have something to offer. Like, I'm not going to go talk to someone, I'm not going to go invest in an aerospace company. I know nothing about aerospace. Like, what am I going to offer the entrepreneur, right? It's going to have to be something where I can offer something to that entrepreneur.
Yeah. If you look at your day-to-day role a little bit, I'm actually curious, like, what do you wear today? Because you described a little bit about what Equiam does, but I don't know that I actually fully understand what your role looks like.
Yes. I wear a lot of hats, but mainly my hat is I am actually the one here who is responsible for making the investments into the company. So out of all the partners here, I have the one who's got the most experience in kind of like primary investing. So I'm the one who, we've all built the model together, which splits out the top companies, but I'm the one responsible going out and finding the investments in those companies, screening them, writing the investment memo for the rest of the partnership. So that's kind of my role. And that's what I love to do. So I'm glad that's my role here.
That's awesome. And now I could get why you also described, it sounds like you would do what, if you ever did decide to go out external and do it, well, you're doing what you would do if you were to acquire and look at other companies. So there's not a huge change there, I guess you could say.
I'm doing what I like already.
You kind of started giving those advice a little bit, but if you are kind of looking at a room of aspiring founders, kind of what advice would you give them?
Great question. My first advice, and this is counter to what I do, is, build out as far as you can without raising any outside capital. So, bootstrapping, right? Like, if you can find a way to build a business without going out there and raising capital, you're way ahead of the game already, because you've done two things. One, you've kept a lot of the equity for yourself. And two, when you do go out to raise capital, you're at that point where you can prove, empirically saying, look, here's my product. Here's my customers. I know it works. It's making revenue. It has traction. This is why you should invest in me. And you get to kind of dictate the terms in a lot of ways in that regard. So that's my first piece of advice. Is if you can do it, on your own, as far as you can, we hear the stories about maxing out the credit cards. I'm not saying go out there and sell your blood, but anything short of that, go ahead and do it. Friends, family, do whatever. And then second piece of advice is you don't have to do it alone. And what I mean by that is go out and find. And LinkedIn is, I believe, one of the greatest tools that's ever been built. If you have a company you want to start and you have a product you want to build, go out on LinkedIn, find people who may have already done this, reach out to them. And I will tell you, people love when you reach out to them for advice. People like generally being, put in a position of where they feel like they're wanted and they have something to offer. And you might message 5 people. I am pretty certain 4 people will get back to you. They might get back to you in a different way, but you will talk to those people and you will get advice. And you may find that you connect with someone that has such good advice that you bring them inside your company, whether on your board, as an advisor, whatever. But that person can essentially, if it could have taken you 2 to 3 years, that person could cut that time down literally by half or even more in that regard. So I think it's really important to go out there and find people who may have done something similar and really think hard about who those people might be. It's like, if I'm starting an entertainment company, it's not like I'm going to go reach out to Bob Iger and be like, hey man, you want to come sit on my company? Like, think about who may have done something and who actually fits what you want to do, and go out and do it. So I think that'd be my second piece of advice to these entrepreneurs.
It's great advice. And I think, what you pointed out on LinkedIn, it's Art and I, as we've spent a lot of time on there. We've found this, it's incredible, the amount of people. And I think it's blowing up even more with the number of people who are realizing what a great resource that it can be. And I think it's becoming even more of that platform where people see it as, the possibility for a lot more, whether it's business to business, whether it is connecting. I saw a GIF the other day that was Liam Neeson, and he has this movie Taken where he says, I have a special skills and I'll find you, whatever it is. Well, in this case, it was like saying that, but in terms of, I know how to use LinkedIn and I will find you, because it's so true.
Yeah.
You can't track people down that way.
Yeah, I think my advice on LinkedIn though is I get about 15 different LinkedIn messages every morning when I wake up. I check my email. I will cycle through and I'll delete 13 of them because it's someone sending me a spam message or being like, hey, I have got a product to sell you. Like, no, that was not the right approach. Like, be a little smarter on how to reach out to people.
I think one of the ways that works well is, you start, if the person is somebody who's commenting especially or active on there at all, it's like, start by liking and commenting on some of their stuff so that your name's trusted a little bit more before you reach out. Obviously, not everybody's active in that way, but I completely agree. It's just a difference between reaching out. I think, in essence, what you were conveying before, it's like you have the chance to give them significance. They appreciate when you're asking them for help because it shows that you value them. Something really simple like that is, hey, saw this, one piece of advice I'd love from you. That's actually something that I'd respond to more than, as you said, the many people who reach out, oftentimes in a very, like, oh my gosh, are you really trying to sell me something this way? Sort of a matter.
Like, it's that instant pitch. It's like, wait, I'm not ready to be pitched at 7 a.m. yet. Like, hold on.
Yeah. Hold on.
You got a date before you ask to take them back to your room.
Yeah, exactly.
The other advice I would give entrepreneurs is a no doesn't have to be the end of the conversation. Actually, and this happens internally with us too. If someone tells you no, that's great. Go back to them and ask for advice on, why did you say no? What can I do better? What can I, what would make this a yes? And, you're not going to I'm not saying you're going to turn a no to a yes, but what it will do is it'll help you with your next conversation. So you've learned from this no. Like, taking a no and moving on without trying to learn from it is a failure to me. You haven't learned. Like, why not take that no and try to learn something from it?
Yeah, I agree. I've seen it even when it comes to people, when it comes to employment. It's like, I've had people before who they may not have been the one I hired, but the few, and it's almost, I could count them on one hand, the number who actually tried to keep in touch. Later on, when there was a role now, it's like, oh, wait a minute, actually, let me consider you for this. And I will say also, my kids, somehow they're experts at this. I'm trying to learn from. They'll say something along the lines of, hey, can we play some more games tonight? And I'll say no. And then my son will be like, that's okay. Think about it. I'll come back again. And see, I'm like, they're using it on me because they don't hear no. They hear maybe, copy that. And even sometimes, even though I know I'm getting played, I still kind of appreciate that they're not giving up as long as they're not getting annoying about it. So yeah, I think it's brilliant. People should always see.
And my son, Eric, is great at that too. Eric, no. He smiles like, actually, it's a yes. I'm like, no, it's a no. So we have to keep that child spirit in us, I think, as we grow older. All right, to wrap this up, any other insider tips you want to share, secrets?
Venture capital and private equity are typically, closed off to only the wealthiest of people, as an asset class. But if you, have an interest and you really like the industry, you can actually invest. There's a number of platforms out there that help people invest in the asset class as well. So Forge and Setter and all these different things where people can go and actually possibly buy shares and stuff. So that's one. The only other insider tip I have, and this is the most simple tip I will give people, is read. And I really mean this, read. 90% of my job, of my day, is spent, I'm paid to scour the internet That's what I tell someone pays me to read the internet all day long, like disparate sources, like read everything you can, because it's only from reading all these different things that you will form connections. And I'll give you one example. I use this with interviews on people I interview. I once read an article that Germany was going to ban outdoor watering of things. So water outside of the house was going to be bad, except to, like 30 minutes a week to water your grass. So that's kind of odd. And I was like, okay, whatever. Like, I just read that article and I moved on. And then a few days later, I was walking and I was like, Germany's banning outdoor watering. Like, what does that mean? Like, there's got to be some way you can make money off of that, right? So I started like digging around. I was like, oh, can you invest in water assets and all these different things? And I'm like, nah, too complicated. I'm like, what do Germans love? Their cars. Germans love to wash their cars. They can't wash their cars at home now. So what are they going to do? They're going to go to a car wash. I'm like, is there any way I can invest in German car washes? No, I can't. But there's this company called Wash Tech, which supplies all the car washes. I'm like, started looking into this company. It's a public company. Bought stock in Wash Tech. 2 years later, it's doubled. I'm like, that was just like, I read a stupid article about like Germany banning watering. Like, just read and your brain will start to form patterns between things.
I would subscribe to a weekly newsletter from you where you put together your connections, just because that's really interesting. I'm curious to actually test my own here. I would have assumed that maybe that means like an artificial turf if they can't water as much. But would, in your mind, that be a bad idea?
No, I would go. So I researched 40 different things before I came upon, I thought about all of them. That's the thing, is you go cycle through things. And that's most of my day, is just like trying to form connections between things. Like A happened, is it going to cause B to happen? And 9 times out of 10, it's no. But every once in a while, it's a yes.
Cause and analysis, one of the most interesting things that I do too. Not as often as you, but just that cause and effect. And when you have that like a light bulb moment, you're like, wow, that's pretty amazing. Because sometimes A plus B doesn't equal C. It's like, what's actually hidden there that not obvious.
Yeah.
I want to ask you so many more questions, but Arn's going to tell me let's cut it off. So
well, we can always have Arin back because it is so insightful and it's so amazing. I know you talked about LinkedIn, but where else can our listeners find you if they want to hound you?
I'm on LinkedIn. That's my primary social media. I try to keep everything else down. So Arin Nazarian at LinkedIn.
Awesome. Well, we'll make sure to link it at the bottom of the episode or wherever else we post this. But if anybody else has questions or any type of anything about private equity and venture capital, just ask us. Just put the comments or your question below, and we'll help get that answer too. So, Arin, thank you so much for giving us your time today. This has been, for me personally, it's been awesome to learn and understand exactly what your world looks like today. So thank you for that.
Oh, no, thank you both. Appreciate it. Thanks, Artin. Thanks, Mike.
Thank you. We'll talk soon.